This is reflective of a recovering global economic picture. And I may be in a minority on this view, but I think the U.S. is likely over the next several years to surprise on the upside. I think the markets are anticipating that. Europe is certainly not getting any worse from what I can tell. And there are other pockets of real interest around the world. Look at what's going on in Japan. So it's not totally irrational. And the banks are in the middle of managing the flow of capital between issuers and investors, helping make loans. There's been enormous boom in refinancing mortgages. It's not surprising to me.
You've been bullish on the prospects for the U.S. economy for quite a while now. I know this because you've told me. And you have been out in front of expectations. Expectations and reality have caught up with your view. Given that's the case, and I sense that you feel similarly today, what should the Fed do?
Well, I think the Fed, firstly, I think Chairman Bernanke has done a phenomenal job, and just watching him testify, you think of all the things he's been through for this country, so hats off to him. I think the Fed has played this well. They need to see concrete, unambiguous signs of recovery, at which point we should all celebrate the fact rates are rising, because it's a good sign. When rates rise, it's a reflection the economy is recovering.
Higher yields are a good thing.
Ultimately, it's an adjudication of the strength of the economic platform that is propping this country up. So
is the market right to be pricing in less stimulus now?
Well, the market's always trying to time it, and nobody's. If it was so easy, everybody would be, have much easier lives. So I don't know if the timing is right now or not. It seems like the chairman and the board have been very patient and have wanted to see real concrete evidence. So I think the market may be a little ahead of it.
If you were sitting on the FOMC today, would you be voting to start the taper in the third quarter?
No, I would not.
Why is that?
Because I think you need to see enough concrete signs, and I think the chairman laid out 6.5% unemployment as the target, and I don't know why you deviate from that.
The Fed is one of the country's most important bank regulators. Certainly they have a lot to do with your business.
Sure.
And they, together with the other regulators, have just introduced a new requirement for you, the leverage ratio.
Sure.
How do you feel about it?
Well, this is a continuation of trying to find the right position for this industry, which is the backbone of any economy, financial industry, make it safe and stable at the same time, leave it in a position where it can drive economic growth. We'll all manage, I believe the large banks will all manage against the new leverage ratio well in advance of the ultimate application, which I think is 2018.
But does this new ratio of 5% mean that you will not be able to return as much capital back to your shareholders as you wanted to before you found out about it?
Not necessarily. I think, our capital plans will reflect, firstly, the accretion of earnings. We've now had 3 quarters, each plus or minus $1 billion. It's been a long time since Morgan Stanley's had that. That puts us in a different position, which is why we asked for and received approval for a $500 million share buyback from the Federal Reserve going forward. So
a happy surprise for your shareholders.
It was a happy surprise, and it was a necessary step. It was, and we said this, we said the most important thing was get the wealth management deal done with the capital that required. Then we would start talking about our financial management, which is buybacks and dividends and other things. This was a necessary step. It is evidence of the stability of the institution.
What about the potential for unintended consequences with regulation? Larry Fink, the CEO of BlackRock, I presume a client of yours,
sure, told
me last week that a leverage ratio, because of the way that it treats capital, but more importantly assets, differently, could force some banks to sell off Treasury holdings because they're no longer as attractive from a risk-weighted standpoint. Do you agree?
Well, firstly, we're in a comment period, and it remains to be seen whether any securities would be exempted as they were, for example, under the Volcker rules. So I think the Federal Reserve has to be very thoughtful about thinking through potential exemption of whether it be treasuries and ensuring that there's no disruption to the market as a result or unintended consequence, as you call it. So let's get through the comment period. I think the Fed will be very thoughtful about this. And then, the banks will manage their with whatever cards they're dealt.
Of the 4 people, James, considered the front-running potential successors to Chairman Ben Bernanke, Janet Yellen, Tim Geithner, Roger Ferguson, Larry Summers, do you have a preference?
No, I don't, and I wouldn't comment on it. I know some of them quite well, and I know all of them a little bit. What's great is that we have such a great group to draw from.
How much of a difference does it make, though, to somebody in your position, and to your clients more importantly, who sits in that chairman's seat?
Oh, I think it makes a big difference. Look at over time. That without naming names, there have been a great chairman. I will name one right now, Chairman Bernanke, and there have been other, let's just say, less great. So it matters. But I think what the markets are looking for is a consistent approach on the path the Fed has been on for the last couple of years, for the next period of time.
Consistency is important. And there's some confusion right now about the consistency of the Fed. The chairman has, in his testimony yesterday, and which continues today, done his best to try and eliminate some of that confusion. But it does appear to be affecting the markets. Does Bernanke's commitment to transparency end up confusing people?
I don't think so. I think, you know, the markets get too clever for their own good. They try and pass every single word that he says. I think he's been very clear. The best indication of economic recovery or stability for this country is unemployment at 6.5%. You draw your own line at which point the Fed starts tapering. Does it taper when they feel like they're on that clear path? Does it taper when it hits the moment? You draw your own point.
You have, if not a unique, a very privileged view of investor behavior by virtue of your institutional and your retail brokerage business. How are clients reacting, particularly in wealth management? Are we seeing the great rotation yet? Are people rotating out of fixed income and into equities finally? No,
we saw some rotation towards the end of the second quarter when there was a movement in the bond prices. So we saw some, but no, I've been surprised, honestly, Eric. The mood of the client is very balanced, very thoughtful, bordering on cautious. So there's no irrational exuberance in the marketplace from the retail investor at this point. So things are reasonably, I think things will move in gradations, incremental change.
Is the money that's been parked on the sidelines coming off? And if so, what do people want to buy?
Not coming off much. You know, if we have good product in the system, then that product is bought. But there's no chasing returns at this point, which I regard as very healthy. So if we see the S&P and the Dow solidify at these levels, if we transition to an economic recovery as evidenced by 6.5%, if we see GDP growth around 3% in the U.S., all of these things, then I think we'll see stronger investor activity. Right now, they're being patient.